Okay, moving right along, we have our last session before the lunch break. And what we've got here, these two gentlemen have actually just come straight from a conference at Canary Wharf for regulators. There's a regulator event. They're going to probably talk a little bit about that. What we're really going to focus on here is de-risking DeFi. It's going to be a fascinating conversation. Please join me in welcoming Conor on the stage from Web3 Labs and Amit.
Hey.
There we go. Okay, gentlemen, take it away.
Fine?
Yeah, I think. Okay, just doing a quick mic check. Can everyone hear me loud and clear? I've got my questions on the phone here, so yeah, just so everyone's aware what I'm looking down at here. So Amit, for those of you who, well, I'm sure many people have heard about Polygon, but probably not as many people know about you and your background. And I think it's really good for us just to start with you giving everyone a bit of a bio, because you were kind of almost at ground zero of DeFi when it started happening, and because of your background, you were uniquely positioned really to jump in and come at it from a sort of perspective that's more academic and rigorous than potentially some of the broader groups of people who jumped in who are just speculating.
Yeah, thanks for the, I think it's audible, right?
Yeah,
cool.
you're good.
So hi, so this is Amit. So I lead the DeFi research at Polygon and also take care of crypto economics of an ecosystem. Before giving my background, I would like to give the background of Polygon, like what we do. So Polygon vision is very simple, like, mass adoption of blockchain technology, bringing Web3 to the masses. How we are doing it? We are doing it by scaling the Ethereum ecosystem. We are doing by it providing a technology in which hyperscaling solutions are possible with the least amount of friction. So for example, we do have a primary solution, a proof of stake solution, which is Ethereum based, on which 135 million active users are there. There are around 40,000 decentralized apps on that. To give you a sense of how adopted we are going, how much traction this Web3 is getting into the whole Web2 economy. So for example, Meta is now on Polygon. You can mint your NFT or DPs on Polygon, Stripe, Starbucks. So all of these organizations are trying to get their Web2 ecosystem to the Web3 ecosystem. And of course, there are basic primitives, DeFi primitives like Uniswap, ARB, lending, borrowing, trading. All of the things are on Polygon. And we have like $1 billion TVL logged. Regarding my background, thanks for giving an introduction earlier as well. So my background is kind of a mix. I have engineering degree background, and I have worked for traditional finance in middle of financial crisis, and that time I realized, like, things are not working. Then I moved to the proper academia. I did my PhD, and while doing my research, actually, I got hooked into the Web3. So after doing all this, complicated stuff, now I work for trying to find out new primitives, next generation protocol, trying to work with amazing people down there in crypto. I think that's what it is super important. What differentiates Web3 universe? I think it's the people. It's the people. It's a sheer amount of energy. It's a sheer amount of innovation, and that's what I'm after. Trying to get to build new things, trying to get people work out with the smart people to get new primitives, new use cases, and to make things work.
And so before we get on to kind of the more of the content, which is more about this idea of de-risking DeFi, we're going to be discussing. Just wanted to ask, what's in your mind, the single most important service that DeFi either provides now or will provide in the future?
That's actually, I wouldn't say there's a single most service. I would rather frame it in a way which is more Web3. So what we are trying to build a new primitives which are actually decentralized and trustless. So imagine anything which runs into the traditional finance world. You interact with any bank, like suppose you want to lend and borrow. Okay, we want to redesign that system and put that into on-chain in a decentralized way, in a trustless manner for the community, and they are being run by community. So that's like, and lending and borrowing is one of the biggest use case. Another biggest use case are stable coins. There has been a lot of discussion even from the CBDC, central bank stable coin, but that's another one of the biggest use case. What we are essentially like trying to get there is a complete financial market. What we are not trying to reinvent everything, but we are trying to make things better, which are there in the traditional finance system. Trading, for example, like we have names like Uniswap, QuickSwap, and other trading engines, which you can swap the token in a trustless manner, or swap any currency. In the future, you will see a lot of tokenization being done. I think we are at this cusp of time, we are at the moment where you will see the securities getting tokenized and getting transacted in a trustless manner in an app like Uniswap, which is quite different, efficient, and less costly than the traditional exchanges, which are centralized.
And so to move it on to the, I guess, the risk aspect of this, now there is sort of perception that there's still a fair bit of risk associated with DeFi because of the hacks and these other things that have been seen. But what in your view is the most important thing that's missing right now from DeFi?
So yes, risk is one of the most important factor, and we at Web3, blockchain, and DeFi native take it very seriously. By very seriously, I mean the nature of risk is quite different. So there are two kinds of risk which we deal with. One is the financial risk, the financial stability. That's a classical form of risk. In my past, I have worked for large financial banks, and in the middle of financial crisis, I think most of us would have seen this headlines in which the downgrading of a security or the security tranche didn't happen as quickly as the world or as the regulators which have wanted. What was the core reason of that? I think transparency. Only certain large firms have the micro information about what's happening with their underlying risk. So that was and if that risk was not transparent, and then when the things are not right, some person, a centralized person, decides whether to give that information to the public or withhold that information. And now flash forward the risk in DeFi. So one of the things which decentralized finance does is like it makes this the risk transparent. You can actually query on the blockchain and see what are the underlying assets value. So that is, and we are building a solutions and technological solutions in which these autonomous protocols would be able to self-manage the risk. By self-manage the risk, we are actually putting on very latest tech like agent-based models and other mathematical foundation into this decentralized protocols, and we are trying to optimize the protocols in an autonomous way, so that the risks are actually maintained and the financial stability is transparent, and it's up to the people to actually change it. So that's the first risk. The second risk is security risk. It's you open any website, any news website, you will see like security hacks coming up. So the technology is new. I don't deny that there are major security breaches in the past. But again, we have been doing a lot of works, a lot of manpower, money power, and lot of intellectual power has been getting invested in making those security audits, making code works as it was supposed to be, and it's moving in the right direction. So there are like triple layers of security. Even some solutions are coming up which actually ensures your security hack. So let's wait and see. Like, but these are the two major risks actually in DeFi, which we actually focus on.
And within that sort of landscape, something that we've spoken about before as well is protocol solvency risk. And that's something, of course, that people probably don't really talk about that much right now, but as you've said, is very, very important. So what would you say about how you can actually assess protocol solvency? Because it certainly fits into these categories of risks that you discuss.
Yeah, that's a question actually which whole financial system is built upon, like solvency. Like so, you go like you have a bunch of money from your hard-earned savings, and you deposit that into a bank, a centralized bank, and sometimes they give you 0% interest rate. People are thinking about negative interest rates sometimes, but the fact of the matter is you don't know what the status of that bank is. You rely on some central authority, maybe a central bank, maybe a regulator, to keep on investigating the bank and see whether that money is safe or not. In the back of shadows, what does the bank does? They actually lend that money to someone else. That's how the fractional reserve system works. They lend it to some person who is maybe doing some very high risky business, okay, and things might go wrong, and at one fine of day, you maybe 6 months down the line, you go to the bank and then they say, okay, we don't have money because we have lent your money to a person who is actually very highly risky. Okay, but the problem with this system is transparency. You really need to know where your dollars, where your pound has actually went. And if you do this thing on-chain, suppose you bring this banking system on-chain, there is a certain amount of transparency which you can calculate, and even the users can calculate with the help of an app. I'm not saying like users should do it mathematically. With the help of regulators, regulators can actually bring about nice fancy dashboards. The dashboards which they see in 35th floor of a bank with the senior executives. Users should be able to see that, and you can assess the risk of the bank or the decentralized protocol which is on chain by yourself. Like nothing should be hidden. It's your money, right? Like even like $100 money is big for certain, maybe a person who is saving it for 10 years, like 6 days, 10 days, 100 days. So that's the risk we are talking about. How to assess that, how to make it happen, then there are mathematical tools to do it. And these are the same tools, believe me, which traditional bank people, which the regulators are trying to stress test. So essentially, you can stress test. You can, there is, you might have heard like, the stress testing is a very stressed time for banks, because then the regulator comes and actually stress test you and you fail in like 2% or 10% of the things. Then they say no, you need to add like $100 million to this account because you're not in certain scenarios, a black swan event, you might fail. So this is like insurance money. And you can do the stress test with the DeFi protocols, and that's actually happening. The DeFi protocols, the lending protocols like ARV, Compound, and others, Zero Wix. So these are being stress tested by this modern technology, and we can do it because the things are on chain. That makes this whole system resilient towards solvency. Like if you have enough assets all the time, if your risk is not hidden, then yes, you are actually making the system kind of prone to this negative shock.
And so with that, when we think in terms of what how you articulate the risk associated with that, we all saw how the GFC played out with respect to the ratings agencies and arguably not necessarily the right incentive models for them to be using with respect to assessing risk of these different types of over-the-counter traded securities, such as the residential-backed mortgage securities and everything else. And so how do you think for the end users this idea of articulating that risk could look like? Because right now it's almost like you need to be in the know with DeFi. You need to know what are kind of the popular protocols. You can maybe look at like the total value locked in specific protocols as a good indicator. But these are not tools for your average person. These are tools for your Web3 natives, people who understand things like self-custody. They're comfortable enough like passing cryptos around and working with smart contracts. So how do you think that could play out?
I think that's one of the most important questions, because sometimes DeFi gets too complicated for the user to get on board. There is an example of it when the companies like Uber and Airbnb came. It just reduces the user friction. User experience are better. So we at Polygon actually are now, so there are, so if you think DeFi in like a certain amount of, what do you say, a block, then the last phase of the DeFi was actually bringing about this primitive, trying to figure out mathematically and engineering wise how to make this system work on blockchain. And we have been quite a bit successful. There are of course some challenges. The next phase at Polygon as a whole, and also at a crypto or a blockchain ecosystem, is focusing is on the user experience. Like how to bring those millions or a billion user onto this new financial primitive. That will require a certain amount of innovation on the user experience front. User does not need to see the complicated workings of decentralized finance under hood. There would be an apps kind of a scenario, just like you order a taxi on Uber. You don't worry about like what make of a car is, like how it's a mileage, like what's a gas, what's a tire gas value. So you don't worry about that. You just order it and it just works. And that's how DeFi we are investing ourselves in making those nice tools, nice application, which will make this system frictionless. The example of that is some of the risk metrics are available as a front-end dashboard. You can just put down your account number, which we call wallet ID, or and just you can see all your holdings and sometimes your risk associated with it. So that's kind of a tool which we are thinking on. You can quickly onboard on any DeFi application. We have a huge interest in bringing the integration of Fintech with the DeFi. For example, we integrated with Robinhood. So Robinhood Web3 wallet is exclusively on Polygon, and you can actually buy, trade, and use DeFi things on that Robinhood DeFi Web3 wallet on Polygon. So these are the things which will actually bring mass users to the Polygon.
And you can kind of envisage a future where, if you think back to Google, like the big innovation that they provided was, it wasn't that they were the first search engine, it was the fact that they just organized the information better than anything else that was available. And in terms of down the line with DeFi, maybe we could get to this place where there's like these nice aggregated views where you can say, these are the sort of risk parameters I'm looking for, this is the asset class, this is the time horizons I'm interested in, show me a DeFi protocol that can satisfy this, and to make it somewhat easier to match up the user's requirements with what's already out there in terms of Web3.
I think that's a kind of a product market fit. And this is a very complicated thing to actually engineer it, because theoretically every human being is different, so it has the various different preferences, and aggregating those preferences into a certain products is a very challenging task. But it's challenging, but it's what brings bunch of large amount of users to on-chain. That is why this integration with the current apps, like we have a huge knowledge base. Like when we say Web3, DeFi, we also have a knowledge base of Web2. How Web2 or how application system of Web2 has been able to make billions of users come on, using internet. We can discuss like, centralization and data rent seeking, but still it's quite successful in doing that. So we are kind of learning from that that process. And suppose like, for example, like what will make a lending and borrowing app attract a bunch of thousands of users? Oh, I think it's very easy. If you look at how the traditional banks have been doing fairly well with those internet account accessing with the app-based platforms. So we are moving ahead in the same direction. We're going to integrate your savings account, let's say, in future with a DeFi app. You can access the yields or saving interest rate from the DeFi app, just like you would access it from the bank account. And it won't be zero. It would be significantly larger than zero.
Yeah. And so moving on from this idea in terms of the access to these protocols, one of the other areas which is likely to evolve over time is with respect to collateralization. Right now, the vast majority of assets locked on DeFi protocols are fully collateralized, i.e. if you want to borrow $100 worth of, put down $100 worth of like a crypto to get something back in return, you get one for one there. You can't really take out leverage. Now there are protocols who are working on that, but it's still fairly nascent in the space. Do you see it as something that it's only a matter of time before we start to have much more sophisticated risk models? So you have, in effect, on-chain credit scores for be it specific users or wallets, or how do you see it playing out there?
Yeah. When I was doing my PhD, actually, one of the project I did was on like a fully collateralized back loan on-chain. I wrote a paper, and at that point, I realized that this is super capital inefficient. It doesn't. If we are able to maintain the system, this would be used by only few. And then fast forward a couple of years, and we have the demand of under collateralized loans. Just how you do it in the proper banking system. How are you able to offer under collateralized loan? One of the main driver of that is credit rating. Like by your trustworthiness given by some number. Maybe a FICO, Experian, you have some numbers, and you're supposed to be higher than some amount to get a loan or a good interest rate, let's say. You are being less, the judgment of credit riskiness on chain is the next thing which is gonna get merged with under collateralized loan. And we have some of the protocols which are attracting millions of dollars. For example, Clearpool is a protocol which offers under collateralized loan, and that has, I think, millions of multi-million dollars loan being syndicated today. There are three things which actually under collateralized loan do. First is trying to make a kind of permissioned way to access the pool, because sometimes when you want to do under collateralized lending, you want to do some identity check, because there is suppose the lender only wants to give the under collateralized loan if the identity of other person is verified, the KYC, AML kind of a thing. The second thing is trying to get on-chain credit rating. That means your credentials of past credit defaults, your payment schedule is gonna get on-chain. The third thing which is actually we are building is that about your on-chain trustworthiness. Like it's a different thing in all itself. Like right now you still have to rely on some centralized source to gather some data, like what would have been your trustworthiness in this banking system. But going forward, I think if you, like suppose if you transact with me and I know you, and you have been performing really well in a less risky way with me, I would be able to give you some on-chain points to increase your credit worthiness. And you actually interact with 1,000 other people, and you would have experience with them, maybe financial experience, maybe social experience. So they would be able to give you some points which will get aggregated on some rating, a trustworthy rating. So these kind of things, like new techs are being developed, but under collateralized lending, they are there and they are gaining a lot of traction, and we have seen it actually.
And then just finally, before we just move on to the questions that are there, one of the challenges for end users, when you think in terms of mass widespread adoption, is around it comes from the immutable nature of the technology, right? It's in terms of if you're a Web3 native, you're okay with the risk that comes with engaging with these protocols. But if you're thinking in terms of the average end user, someone who does not have the time nor inclination to actually go deeper to understand what's happening behind the scenes. They're just looking at the headline rate of the yield they can get by putting funds into a protocol, or that protocol tends ends up being one that is riskier than they realize, or they simply make a mistake and lose funds. There's not really any protection for them at this point in time. Now, in the traditional financial systems, intermediaries kind of exist for that very purpose, such as banks in that regard. So what are your views in terms of what the end state is for DeFi in that respect, so that the average person has a level of security or guarantees that if they mess something up, they're not going to find themselves without any funds, because those protections don't exist right now if people don't go through an intermediary?
Yeah, that's in like one of the major pain points. I can see there are two directions we can go about that. One is the large banking system trying to adapt the DeFi, and they run and application layer chains, which is decentralized finance centric, and they take some kind of onus in an insurance way that if your funds are lost because you have a bank account kind of interaction with the DeFi application, some funds are actually would be returned to you. So that's like one of the way, which is a very quick way regulators can come in and make this happen very quickly. The another way, which is like a public blockchain, a real decentralized way, is trying to have a social insurance out of it. Like, because this is a community based project, like Polygon, Ethereum, everything is community based projects. And we are actually also seeing some of the solution which actually insures you in a decentralized way. It depends on like how, there is some, of course, risk, and the risk is for everyone. Like, you know, the risk is for me, the risk is for you. And all these insurances, the maths of insurances works pretty well. If everybody pays a very small share of insurance in a decentralized way, you can aggregate that money, and if there is a probability attached of a hack, which will be reducing along the time, because as the technology is developing, suppose there is 1 in 100,000 chances now, in 10 years down the line there will be 1 in million, 10 more years down the line there will be 1 in billion. And if you aggregate all of that into a social insurance, on-chain insurance, the cost will also go down. So that's another way, which, but we have a solution. It's not like we don't have a solution. It depends on like how much users are okay, what kind of insurance do they want. And yeah, that's what I'm thinking.
So it's either the bank stepping in or the community stepping in, fundamentally.
Yeah, exactly. Like either you have some sort of short-term insurance, like if regulators decide like your bank account is linked to decentralized finance, then you should have certain amount of protection. Or it's a social insurance. I'm in favor of the second one.
Yeah, very cool. Right, we've got just over a minute left. We'll see if we can answer one of these questions. It seems that the biggest DeFi risks these days come through the bridges. How is Polygon mitigating that? You've got 1 minute.
Nobody is a fan of bridges actually. So there are some sort of bridges which are maintained by certain parties. Like there have been a serious amount of hacks on the bridges. The bridges are not native to the protocol sometimes, so that might cause that is a huge security concerns in those bridges. We are actually, how we are doing it, one of the great example which I can give you is our new solution, which is Polygon ZK EVM. That is a zero knowledge Ethereum virtual machine solution. So it's a layer 2 solution. What do I mean by layer 2? By layer 2, what I mean, we would be bunching lot of transaction and posting a zero knowledge proof on the layer 1, that is an Ethereum. So there is a least amount of security risk in actually scaling the L1 solution. And these bridges which you are just seeing in there, mostly they are being used to have those lot of transaction to go to the another ecosystem which is scalable. So those are like, you know, many use cases. If you have an inherent system which does not require these kind of third-party bridges, then you are de facto more secure. And that's what this zero knowledge, our ZK EVM solution is gonna go up. The testnet is live, you can check it out, it's on our website. And the most important part, it is open source. That's the magic of an open source. If the complicated technology is open source, there is always 1,000 eyes which you are looking at, and they can actually make it better. So, you know, so that's what I see, like, the bridges going forward, or the technology which uses the bridges less and rely fundamentally on upgrading their technical stack and make it more scalable.
So a great note to finish on, and the ZK EVM, it was only released last week, right? So yeah. Well, Amit, it's been great to chat, and hopefully there's been a lot of learnings for the audience here today.
Thank you so much.